Welcome. Today we'll be talking about 5 undervalued stocks for June 2024. Now do keep in mind that I'm not included companies like Starbucks or Lululemon because I actually included them in my previous video about this topic, and I don't want to repeat stocks to bring you guys as many opportunities as possible. So let's jump straight into it. So first of all, we have Ulta Beauty, ticker symbol Ulta, and this is a beauty specialty retailer. As you can see, it is down 22% in the past year, currently priced at $376 a share. But if we look at their valuations, we can see that they would right now be trading at the lower end of the scale in terms of price to cash flow ratio and price to earnings ratio. However, we do not have the values for Q1 2024 yet. Now this stock is not down on bad earnings, it's down I believe on bad guidance for the following of 2024, but we would have to do further research on what they actually suggested the year would look like. However, its past track record is pretty impressive. So we can see their past 4 quarters have been very good, with Q4 being the one that actually accelerated growth in revenue, profit, and net income, with extremely solid margins for the past 4 quarters. However, the net margin is a bit lower than expected. This is alright since it's a retailer and retail stores tend to have especially tight margins, and an 11% net margin is not bad at all for a retailer. Now in terms of free cash flow, we can see their year was a bit weird, with Q1 being a bit positive and then Q3 being a bit negative. However, Q4 they came in at 1 billion free cash flow generation, and if every single quarter was like this company would be a monster and I would be all over it. And finally, in terms of leverage evolution, this company has had their assets way above their total liabilities for the past 4 quarters, being extremely positive and with no signs of a trend reversal, which means that this company is especially safe in this area. Moving on, we have Jazz Pharmaceuticals, ticker symbol Jazz, which is also at its 52-week lows, being down almost 20% for the full year. Now, I chose to not include the price to earnings ratio because in the first 2 quarters of 2023, they actually were non-existent since Jazz Pharmaceutical was yielding negative earnings. And safe to say that this company does not pay dividends, as any normal pharmaceutical company in the industry does not pay dividends either. Now, when looking at their revenue and income evolution, we can see that it has been pretty stagnant for the past year, with Q1 2024 returning weaker than expected earnings. As we can see, their net income came just negative, which is not a positive sign for a company. But when we look at their margins, every single margin stayed pretty stable, except for gross margin, which actually dipped into the negative territory. Now, when looking at their free cash flow, though, this company is extremely consistent, and regardless of having negative net income, they still managed to generate around $300 million in free cash flow, which is extremely positive. Now, in terms of leverage evolution, again, this is very positive since this company manages to keep their total assets over their total liabilities, and this trend, of course, does not show any signs of reversal either, so extremely positive for Jazz Pharmaceutical. Now, stock number 3 is Aon PLC, which is in the insurance industry, and as we can see, it is also at 52-week lows, being down 11% this past year. Now, this company, when we look at the valuation ratios, it does seem like it's getting a bit more expensive, especially in Q1 2024. Now, one good thing about this stock is that it has a 0.9% dividend yield, and it's an extremely consistent dividend, which they have been paying for a long time, and it has a very impressive 3-year dividend CAGR of 6.6%, which for a company like Aon is extremely solid. Now, when we look at the revenue and income evolution, we can see that Q1 2024 was their star quarter, but every single quarter before that, they had actually been increasing their revenues, gross profit, and net income. As we can see, additionally, their margins have been evolving pretty consistently, with their gross margin staying stable at around 94%, and then their operating margin and net margin rising in Q1 2024, with the net margin sitting above 25%, which is excellent. Now, their free cash flow does worry me a bit because although they were able to have higher net income in Q1 2024, they actually had way lower free cash flow than the previous quarters. And as we can see, 2023 was incredible in terms of free cash flow generation, as in Q4 2023, they returned over $1.2 billion in free cash flow. So if we see this evolution again in the rest of 2024, this will be a very successful company. Now, in terms of leverage evolution, this company is right there, as it has the same amount of total assets as it does of total liabilities. Now, this to me is not a very positive thing, since I like companies who have more total assets than total liabilities. However, since total liabilities are not higher and they have been maintaining this for a long time, it should not be anything bad, especially since Aeon is returning such consistent net income and free cash flows for the past quarters. Now, stock number 4, everyone knows it's Monster Beverage, ticker symbol MNST, and it's in the energy drink industry. Now, it's down 9% in the past year, and although it's not at its 52-week lows, I think that this is such a high quality company that including it here when it's had such a rough year is positive. Now, their valuation ratios have been extremely stable, and this is a company that you will not find trading any cheaper. Why? Well, because it's one of the best performers in the past 10 years. As you can see, they do not pay a dividend, so there is no 3-year dividend CAGR, and there is no extra income in case you decide to own this stock. However, when we look at their evolution, their revenue, their gross profit, and their net income have been increasing quarter after quarter, which is very positive. In quarter 4 2023, they did have a slowdown, but they have recovered, and quarter 1 2024 came in better than any of the previous quarters. Now, their margins are extremely stable, and they don't move a lot, with their net margins sitting just under 25%, which is above the 15% threshold that we usually look for. So very positive. And now where I love about this company is their free cash flow generation. It's extremely stable, it's consistent, and it's growing from quarter to quarter. Of course, you do have some spikes like quarter 3 2023, but it's not all over the place. You do see some kind of pattern. And their leverage evolution is just amazing, with their total assets being so much higher than their total liabilities. This indicates that this company is a very safe investment. Now, last but not least, we have Las Vegas Sands, ticker symbol LVS, which is in the resorts and casinos industry. And this company, of course, is also at 52-week lows, being down almost 20%. However, I believe that at the time of recording this, they actually reported earnings, and as you can see in the after hours, they're up 3%. Now, in terms of valuation ratios, you can see that this stock was extremely highly priced in quarter 2 2023, and now they're at a more reasonable valuation of around 10 times cash flow ratio. And I think this is one of the stocks that is being affected by higher interest rates for longer, such as Vici and other REITs. So I think that this valuation makes sense. However, this company does have a very solid track record, so we'll be checking whether that makes sense. Now, in dividends, they yield a 1.34% dividend yield, but they do not have a 3-year dividend CAGR, as in 2021 and 2022, they actually paid no dividend. They reinstated it back last year. And when we look at the revenue, gross profit, and net income evolution, it's clear that this is a very stable company, as the revenue has grown every single quarter, the gross profit as well, and the net income as well. Now, their margins, of course, extremely consistent as well. Their net margin was actually negative in 2022. However, now it's right at around 20%, also very solid. And again, extremely consistent free cash flow generation, which is what we like to see. In the past quarters, however, this has actually decreased quarter by quarter, but it looks pretty stable. Now, in terms of leverage evolution, they have more total assets than total liabilities, which is very solid. So this could be an interesting play. Now, before moving on, I am not a financial advisor, and this is not financial advice, so please do your own due diligence. But thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.